Microfinance India Summit is an initiative of Access Development Services set up to build greater convergence within the sector for its organized growth. Through this forum, which attracts diverse stakeholders associated with the sector, both within the country and outside, specific issues and challenges that constrain the sector are discussed, as also the enabling initiatives which propel its responsible growth. Microfinance India Summit is in its 8th year since it was first organized in 2004, and over this period has emerged as the preeminent sectoral platform. An important session which views the sectoral perspectives on the proposed microfinance regulation was the highlight of the recently concluded Microfinance India Summit held on December 12th and 13th, 2011. Important sector leaders were invited to speak on the panel, who shared their views on the potential impact of regulation on the sector in the current context, the role of self-regulation, while drawing on experiences from other countries in the region. A summary of these discussions and deliberations is documented in this video for policymakers and regulators to understand sectoral concerns on the proposed regulation. The session, titled Microfinance in Regulatory Regime, Will It Rein in the Sector?, was very ably moderated by Dr. Rajiv Lal, Managing Director and CEO, Infrastructure Development Finance Company Limited, and founder and chairman of Lok Capital. The expert panel included Mr. Hassan Zaman, Senior Economic Advisor to the Governor, Bangladesh Bank, Ms. Kate McKee, Senior Advisor at CGAP, Mr. P.N. Vasudevan, Managing Director, Equitas Microfinance, and Mr. Vijay Mahajan, Founder and Chairman, Basics Group.
A few days ago, the Reserve Bank of India came up with a new set of notifications that are meant to regulate a new category of finance company, which they are nomenclating non-bank finance company, MFI. And the question really is, to what extent do you think that regulations can actually make financial inclusion happen?
It may be useful for us to sort out what are we talking about here. So there's regulation that is meant to prevent certain things or deal with a problem that's arisen in the market, but there's also regulation that's meant to make something happen in the market. And I think we might want to explore a little bit that as from CGAP's research worldwide, I don't think there's very strong evidence that you can just mandate inclusion to happen and it will happen. You have to have created an environment, including infrastructure and demand creation and so on, that makes it viable as a business to do something. But you can create a path towards that, and you can create a more enabling environment. And I think that when we look at some markets that are now quite vibrant, actually the regulators acted in a kind of a far-seeking way to create some paths for a diversity of institutions to be able to have a range of viable business models.
I think common sense, and we've heard it in different measures through the comments, suggests that regulations are best used to protect, to deliver financial stability. Policy is the appropriate instrument to make things happen, to incentivize, right? Why is it then that central bankers, well, certainly in this part of the world, in India and Bangladesh, are so keen on prescriptive policy that you shall lend X% of your loans to priority sectors defined in ABCD manner? And all the empirical evidence suggests that these have been singularly unsuccessful.
First of all, you know, this dichotomy between policy and regulation is somewhat blurred. There's a clear gray area of which one is which. But for instance, in what I can speak for is in Bangladesh, the way we've done it is that we've said the regulation of the microfinance industry will be done by an independent regulator called the Microfinance Regulatory Authority. Now, we can discuss a bit later of how that's all structured. But what we have set as an explicit goal is, in addition to financial stability, especially over the last few years, we have emphasized the goal of promoting financial inclusion as well. And that can be done without necessarily having a direct regulatory oversight over the microfinance institutions. So the way we're doing it, for instance, is by promoting financial literacy on a massive scale. that's going to be launched soon. We're also sort of strengthening payment systems, especially the mobile banking systems, so that the financial inclusion objectives which the private sector will deliver are achieved through that. So we believe that strengthening the overall financial architecture and ensuring financial stability will help in financial inclusion objectives. But that said, the one similar thing that I can say we do have with the RBI is that we do have certain targets for agricultural lending of about 5% of total loans outstanding of commercial banks. And we do have some targets for reaching to the SME sector as well. Several of these targets are fulfilled by commercial banks through microfinance organizations though, and so a lot of the monitoring and targeting is done at that level.
What is your first reaction? Do you think that the RBI notification finds the right balance between the need to protect the interests of poor borrowers and the need to ensure that we create sustainable, viable business models to deliver financial inclusion?
I think that the RBI notification of May 3 and now the December 2, which is added to it, is a very good step forward, but it should not be the final resting point. I don't think it's appropriate for the central bank to regulate specific prices. They should regulate rules of the game. They should ensure that predatory or other forms of bad behavior do not take place. But they should not really micromanage down to the level that the May 3 and December 2 circular have on the level of income, what percentage of the loan should be for productive use, etc., etc. So many restrictions.
Turn to Vasu. You have been one of the few MFIs that have embraced the regulation relatively quickly. I wanted your honest assessment, imperfect as it is, the RBI notification. Is it something you could live with for the indefinite future? Can you build a decent business within the confines of the notification?
Obviously, more welcome. If you look at the guidelines which have come on the 2nd of December, the principal things which are applicable is from a lending rate cap. You have a lending rate cap of 26% and a margin cap of 12%. The second thing would be in terms of the amount of money that you can lend to a client. So not more than 2 MFIs can lend and not more than 50,000 rupees. These two are, I would say, among so many other things, these two I would just take as very crucial pieces of that regulation. And if you look at the 12% margin cap, if you assume that you have to provide for a 2% delinquency, because it's a completely unsecured loan, so minimum you have to provide for 2%. And if you want a 3% return to make it a sustainable business model, then you are left with 7% for your operating expense. The question is, how many MFIs can actually operate at 7% operating expense? Historically in India, except very few MFIs, I think about 3, 4 or 5 MFIs, there's been no history of even single MFI operating at less than 10% operating expense. So from that scenario, we need to now move a significantly large number of players to a 7 to 8% operating expense ratio. Now, is that a big challenge? Obviously, it's a very big challenge. How many are going to do it, or how many are going to be able to manage it? Is a question each MFI has to answer it on their own. But I think that's going to be a great challenge to, assuming that the regulatory risk is kind of settling down, assuming that there is no more regulatory shock to the sector in the foreseeable future, then the biggest challenge I would still say is this 12% margin cap. I think how many of us can really operate at 7 or 8% operating expense, which historically most of us have never done it, except 3, 4, 5. So I think that's going to be the biggest determinant of the sustainable model. And the second is the amount of money that can be given to one client by 2 MFIs. So earlier, even at 10 or 12% operating expense, we were probably 5 of us were lending to the same client. So I have a branch, I probably have 5,000 clients in the branch because I am lending to the same client, which is probably being serviced by others. Now with this new regulation, I can't give more than 2 MFI loans to one client, which means to do the same 5,000 clients, I may have to open 2 more branches. I may have to go wider. I cannot go deeper and keep doing the same area or same geography. So which means again cost. So again my cost of expansion, I have to expand the branches even to do the same number of clients. So again that's going to add to the cost. So already we don't have a history of people operating at 7-8%, and then you go to a model which is compulsorily going to make it more costlier. I think these are going to be challenges, but there is no industry solution for this. I think it's a question of individual MFI solution. Household income of 60,000 rural and 1.2 lakh rupees urban. I think there is one cynical way of looking at it is that all MFIs will just get a self-declaration from the client and show that as a compliance from a compliance perspective. But in Equitas, when the Malegaon Committee recommendation came in January 2011, we do have the income data on the system. So we ran a report and we found that 92% of our clients are actually under 50,000 rupees of household income. And prior to the Malegaon Committee, obviously there was no vested interest in putting any particular figure of income into the system. So it must have been as genuine as our people could have estimated. So I think by and large the sector is addressing the households which do fall within that income level, and I don't think we are far off that mark.
Just a brief comment on the fact that we, in Bangladesh, we don't have any margin caps, but what we do is have a final lending rate cap of 27%, which is set by the Microcredit Regulatory Authority. Again, this number was established after approximately 3 to 4 years worth of back and forth and consultation with the sector on what an appropriate limit would be. And that number 27% is something that 90% of the MFIs which are operating were lending below that, so that cap seemed reasonable, but we wanted to curtail sort of any excesses beyond that. And I think one issue that I wanted to flag is what is it that you regulate? And I think what we believe in is that we regulate something that we can measure reasonably, realistically. And the interest rate issue is something that we first collected information on at the first we set up, going back in time in 2001, what's called the Microfinance Research and Reference Unit within the central bank for 4 years, where we collected data from the whole industry on their balance sheets and income statements and rates of interest, etc. And then they drafted within this unit in the central bank. We realized that we don't have any capacity to regulate this humongous sector. We want to have an independent regulatory authority. So they helped draft this bill for the independent regulatory authority, with the link that the chairman of the board of the Microfinance Regulatory Authority is the governor of the central bank. That is the one link, but most of the decisions are done by the MRA itself. And so I think the point that I wanted to make is that there are clearly some similarities now that I'm hearing more about this RBI bill, but we chose the lending rate cap, and because we felt that was something we could monitor, as opposed to a margin cap, which is harder to monitor, or household incomes, which are clearly difficult to monitor.
The last question on this set of issues to both you and Vasu, given the challenges of meeting the various requirements of the notification, right? Do you think that there is now room to invite, or does it make it more interesting and more viable for a really large-scale, serious player?
Vijay was saying there's space for so many different type of people when you look at the financial inclusion space, because the ultimate recipient of the financial inclusion services are completely different. I mean, you can have a city, urban-based poor who live in very accessible locations where the servicing cost may be different. You may have people in hilly areas, tribal areas, where access itself may be very costly. So it's impossible that you can just look at one type of a player who can service from the financial services perspective. And if you look at the size driving operating efficiency, I have a very different view on that. You know, I believe that the operating cost is not a factor of size, it's a factor of two other things. One is your greed, and second is your efficiency. So if you are efficient, extremely efficient and reasonable in your greed, I'm still saying greed, but reasonable, then I think you can still manage your cost. But if you are greedy beyond a point, whether you are efficient or not is not very material. You will not find this model attractive at all. You just won't find a 12% margin cap attractive at all. On the other hand, if you are very small, let's say you are a small NBFC MFI operating in 4 or 5 districts in a state, and you have no great ambition to expand beyond that, your cost can still be completely manageable, and you can still make a viable model out of that. You don't have to be very large. So to me, it is not a question of size. To me, it's really a question of what's your level of greed compared to what's your level of efficiency and what's your ambition levels. I think if you have a controlled or manageable ambition, manageable expectation of returns, and you back it up with certain efficiency levels, I think this model is perfectly possible irrespective of what size you are looking at.
So I think it's really good that Mr. Khan is here, because central bankers everywhere in the world are trying to persuade investors and promoters that long-run sustainable ROEs of 15% in a financial services business is plenty good. Please do not raise expectations that we can deliver 25%, 30% ROEs indefinitely.
But I believe that there are indeed, it's a misconception that there are economies of scale ad infinitum in financial services of any kind, and certainly let me stay within microfinance. I think the cost curve is a U-shaped curve rather than a downward sloping curve which eventually hugs the x-axis. So, and the reason is the way we work. After a field agent has 300, 400, maybe 500, 600 in case of extremely super efficient, high density MFI customers. Beyond that,
Returns.
He'll have more NPAs, will generate more NPAs, and you'll lose more money rather than by hiving off the portfolio and having the second. So in the elemental building block of your design, operating design, you have what's called stepwise fixed costs, and therefore there is no such thing as an infinitely downward. Same thing for a branch. Beyond 10,000, 15,000 customers, you need a new branch. Same thing for a regional office, etc., etc. In fact, given the fact that microfinance has to be sensitive to local context, can in fact draw upon local culture and other mores to ensure good repayments, it makes sense to have a lot many more regionally specialized MFIs than even one single All India MFI, quite frankly. Since we work all the way from up to Tripura and Arunachal on the one side, and Karnataka and Tamil Nadu on the other side, just the travel expenses are not quite frankly not justifiable. Why do we really need a single All India MFI? Why not one for the Northeast region and so on? So having said that, we don't need to strive for economies of scale on that. There are 2 or 3 areas. One is technology backup. The second is raising capital. And the third is probably, increasing compliance infrastructure. On these, they could be share costs. I mean, for example, why can't there be an MFIN supercomputer which keeps accounts for all of us? After all, we have created a credit bureau which have now 60 million records of all of us, and it's working on a single server. If all the Scandinavian banks can share a single CBS and still be separate banks and compete with each other, I don't see why we can't do that. So, we need the different architecture to
Okay. To move on to another topic, Hassan, I'll start with you and then turn to you, Kate, on the issue of self-regulation. I personally am very cynical about self-regulation. What do you think as a central banker?
Before I touch on that question, if I may address
Please.
something that Mr. Mahajan raised, which is on the sort of optimal size of a particular MFI. I think I fully agree with him that at the branch level there are certainly that U-shaped curve that you discussed, and there's an optimal level of 10,000 or 15,000, whatever it is, and then one should open another branch. I think, however, on the issue of whether that model can be scaled up and cover the whole country or not, I mean, the Bangladesh experience has possibly shown that there are some institutions, as long as there is strong sort of a certain management structure, etc., which can achieve nationwide coverage. So in fact, of the between 17 to 20 million MFI clients that Bangladesh has, about 60 to 70% of them are covered by in fact, about 75% are covered by 3 institutions, Grameen, BRAC, and ASHA, which cover the whole country. Now, clearly Bangladesh is the equivalent of just, with 160 million people, is just one state in India. So I don't want to sort of overdwell that point. On the issue of self-regulation, I think the Bangladesh microfinance industry essentially was self-regulated for the first 25 years of its existence. The microfinance regulatory authority was only formed in 2006, and by which time sort of there were at least 12 to 13 million clients which are already there in the system. And clearly the rationale for having a more formal regulatory system was this issue that self-regulation can only get you up to a certain point. I think it's an important part of the regulatory system, and I think network organizations and others have a very important role in doing so, especially for the very small institutions. But from a systemic risk point of view, when we at the central bank and also at the MRA, we think about organizations like BRAC, ASHA, and Grameen and the size that they have, the fact that total microcredit outstanding as a share of total bank lending is about 7%, the fact that deposits is about 5% of the whole system. I mean, these are become significant players now. And so self-regulation up to a point, but then one needs to sort of up the ante, especially for the bigger players.
If I might ask, what was the trigger for setting up the MRA in Bangladesh?
I think I wouldn't call it like a specific trigger, but as I'd said, in 2001, the central bank decided to set up a small unit to sort of collect data first on microfinance institutions. And then once it collected this data, because it wanted to get a sense of what is the size of this sector in relation to overall financial flows, systemic risk, etc. Once we collected that information and data, we realized that, look, this is larger than we had perhaps previously thought. So let's now formalize this, and then the act was drafted.
Kate, what is the international experience with self-regulation?
I think our question should be, when can self-regulation work relatively better? So it may be a second best solution, but a highly relevant and even resilient one in a lot of markets. I think we rarely find it working well just on its own, except where the consumers are actually in a position to judge quality, and somehow a quality seal has been established so that providers are rewarded in the market for higher quality services. So I think we should think about self-regulation, what's a candidate for self-regulation, really 3 different baskets. One basket, I would argue, is for issues that just can't work on a voluntary and partial basis, because your policy goal is to achieve more of a level playing field across the market, and because the temptations for any provider to cheat are too great. And I would put price transparency in that category. So I think price transparency should be a matter of regulation, not price control, but price transparency. And I think our observation when regulators come to us and say, we're worried about prices in the market, we say, could you think about maybe trying transparency, plain language disclosure, and a consumer awareness campaign first before you move to interest rate caps. So that's the first basket, and I would say that that's a clear candidate for just plain old regulation. The second basket is more is things that are kind of hard for providers to do. And there, I think there needs to be some outside force. It might be the threat of regulation. It might be delegated supervision, as we have here. It might be lenders and investors that are creating expectations. So something like lending practices and collections practices, I would put in that category, because in the long run, you've got to get it right, but in the short run, you might be rewarded by not doing it very carefully. And then the third basket is things where it's more of a win-win for industry, and where I would consider, and we see examples, and an issue like grievance redressal. In the short run, that has a lot of advantages to your business. And maybe that's something where capacity is limited by regulators to say, leave to industry for a while and say, have a go at it, see if you can make some progress there. We're watching, we'll set some standards if we need to, but let's see what you can do. And the last comment I want to just make on this, I'm thinking about Vasu's opening remarks about the trigger in the market and when something is going wrong. And I think that when that point is reached is the moment to sort of look at and really challenge industry. Can you have a credible response on this topic, or shall we move to regulation? And so I see it very much as an interactive. It kind of should be an ongoing dialogue about what is amenable to some form of self-regulation and what kind of incentives to enforce are needed. And clearly here, the investors, the lenders need to be at least as large an incentive as the threat of regulation.
Very sensible. Vijay, you want to add something based on your experience with the code of conduct?
Having struggled with self-regulation for several years, I have come to believe that we should aim for the second best, which is what I call mutual supervisory organization instead of a self-regulatory organization. And by that I mean that regulation anyway for a long time to come will be with the RBI, and it's unlikely to be delegated down. We can at best play an advisory or an advocacy role in regulation. But supervision and mutual supervision, you set a thief to catch a thief kind of philosophy, is I think quite doable. And indeed the credit bureaus is the first beginning, but there are several other examples in the code of conduct. Whistleblowing has been elevated to something desirable and so forth. So I think we should aim for that and eventually get an approval from the regulator that we are a delegated mutual supervisory organization and have some teeth to it. If we arrive there, I think it will be the best of both worlds, because the micro observation that is necessary can only come from peers.
Mm-hmm. What has Bangladesh's experience been in actually facilitating this through devices such as banking correspondence or other regulatory alternatives?
When you think of the last mile, let me share some data from the last round of the Household Income and Expenditure Survey, which is a nationally representative survey, which shows on the access to finance module that of those households who took loans, 75% of them took them from microfinance institutions, and about 5 to 7% took them from commercial banks. Now that's an exact reverse proportion to the volume of lending. Of course, the volume of lending is much more skewed in the other direction, but in terms of the numbers. So when you think of the last mile, I think let's keep that context in mind, that most of it at the last mile stage is done by microfinance institutions, and that when commercial banks, to fulfill some of the targets that we set, they essentially do it in partnership with them. So that really is the linkage that takes place. They do it in partnership, and plus several of the microfinance institutions also borrow at commercial terms from commercial banks as well to essentially do this loan financing arrangements.
Bangladesh is more or less committed to the partnership between banks and MFIs, and that's how it's played out. Here, clearly, we are experimenting with a much wider range of possibilities, and one of the things that we keep struggling with is mobile banking. We hear a lot about the success of mobile banking in Africa. From a regulation perspective, what made this happen?
Well, the glib answer is no regulation. Okay. So if we look at Kenya, essentially the central bank said, this is the famous M-Pesa model. We think it is a payment service, not a banking service, so we are choosing not to regulate it. Let's let it run, and we'll see how it goes. And other countries have chosen that kind of approach. In a way, I guess it's back to Vasu's comment, let the market run, when there's a problem, respond. And picking up on Hassan's point, so it was when then M-Pesa became quite large that I think, I must say the Central Bank of Kenya was extremely thoughtful in kind of closely monitoring, and there was a great deal of moral suasion that was going on about how would consumer protections, for instance, be built into the model and data security and so on. But it was basically a wait-and-see regulatory attitude. And then at the point at which it became large, and also when competition was important in order to provide better prices, more consumer choice, and so on, that was the point at which in Kenya they chose to start like regularizing through regulation. Other countries have set some simple rules in the beginning, but have also just not set bounds on it, but also have kind of encouraged a more enabling kind of approach of saying, we would like to see these diverse set of players able to work together and innovate and try some things in this space. So we shouldn't be thinking of regulation only as something that constrains, but that can also enable. And actually clarifying what's permitted can be quite powerful in letting a market response occur.
Vasu, and I'll leave the final word to Vijay. On this issue of mobile banking and how you could use it.
We did even meet some RBI officials. So the question that I asked him was, is there a data of business correspondence? What's the volumes of savings and transactions done through the business correspondence, and what's the volumes of loans which have been given through the business correspondence? Frankly, I didn't get the answer, but I think it'll be very interesting if RBI actually finds the data, because my feeling, and I have spoken to a lot of bankers, there's a huge discomfort in lending through the banking correspondence, because the BC then goes and appoints some sub-agents, and the sub-agents then deal with some end consumer. There is no way that a bank sitting far away is going to take a credit call based on some sub-agent's comfort to pass through a BC pass to the bank. If that is a reality, if indeed the BC model is not generating loan transactions, but it is only supporting the savings and other banking transaction activities, then why not give it to NBFC MFIs also? Because the reason for RBI not giving it to us, but to everybody else in the country except NBFCs, is that we have a natural conflict, because we are also lending, bank is also lending, so on whose balance sheet should I put a loan when the client approaches me? So I will only push my product, which may not be the best for the client. That's a natural conflict which they want to avoid. But if the BC is actually not doing the loans and they are only doing the savings and transactions, then why not allow us also? That would not just help the MFIs. It's not so much from the MFI perspective, but truly the best cost-effective way of reaching banking services, which is savings and transactions, to the end user is through an MFI only. Not through any other model, including the BC model, because the BC is creating an infrastructure. I already have the infrastructure. I am meeting my clients once a week. I may have 2 million clients, but I meet them 4 times a month, face to face. I spend half an hour with them. At the same cost of doing that transaction, I can comfortably give a handle. I can do a savings, I can do withdrawal, I can do anything to that client with absolutely zero incremental cost. The NBFC MFIs are definitely the best place from a BC perspective, and the client will get a holistic service.
Yeah, you actually took the questions out of my mouth, and you see by the applause that you have a lot of support. So I'll just come back to you, Vijay. Hassan, you had an observation on mobile banking?
Yeah, on mobile banking, we've taken a different approach from the Kenya model, which is essentially telecom-led. We feel that it has tremendous potential to get to the unbanked and to the financially excluded in Bangladesh, but we've decided that we're going to be fairly conservative on our approach to it, and so we've set out the guidelines that it's going to be a bank-led model in partnership with telecoms, but it's going to be bank-led, and we've given licenses to about 5 to 6 different experiments, and we're also launching some quote-unquote action research to monitor how these experiments play out before we move into a bill forming stage. But that's where we are. We are very much at a nascent stage, but we are taking quite a conservative approach to this, and we want to sort of, in a sense, be sort of with the industry and not play catch-up, as perhaps we did with microfinance.
What would be your advice to the RBI on mobile banking and on banking correspondence?
I totally agree with Vasu that at least NBFC MFIs should be included in the category eligible to be BCs. But at the same time, Vasu, the BCBCs, that is the ones which are not doing through the NBFC model, is actually a very technology intensive and very efficient model. So let the two work separately. You know, we should be into model pluralism rather than saying mine is better, mine is better. Both should be permitted. The other point about loans, you know, at least in the current regimen, there is one type of loan, which is the overdraft loan, which can easily be done by a bank because they just have to observe the average balance in the account and they can do it on that. So I think over a period of time, even the loans will start happening. But right now, what we need is, we need the network density. And the mobile will of course dramatically enable that. And you know, while I have seen the Kenya model and it works very well, but there are transaction cost issues there that, you know, which we have to take into account. It doesn't work well for small transactions. So it can't be the basis for savings. And as the relative lack of success of M-Kesho as against M-Pesa shows, M-Kesho was the M-Pesa mounted on the Equity Bank's savings platform and it hasn't taken off. And that's because of the fact that it is too expensive, you know. So I think we need to distinguish between the Kenya model, which permits interlocation payments using the telecom platform, versus a mobile-based savings solution, and we should aim for the latter for financial inclusion.
Thank you all, and please join me in thanking our panelists. Thank you.